So, Tim, can you talk about what's been scoped out of GASB 87 and what that means for reporting?
Yeah, so I think, first and foremost, with any new GASB or FASB, there is the concept of materiality. And so one of the policy elections that organizations are going to have to define as part of the adoption is what will be their materiality threshold going forward. And with leases, that is a different animal than when you're thinking about, capitalizing assets. First and foremost, the risk of that you're solving for is different than your capitalization threshold. And so a capitalization threshold, your external auditors are worried that you're trying to expense something that should be amortized over time. When in fact, with the new GASB standard, we're not really changing the P&L at all, except for classification and moving things to depreciation that were in lease expense. And so materiality is more of a balance sheet consideration. And in reality, if you elect not to record something under GASB 87, you are not recording the liability. And so your auditors are going to look at the lease materiality as a construct of that unrecorded liability. And so as an organization, you're going to have to go through a process prior to loading these into whatever accounting solution that you've got to determine, what is material for the organization, because you don't necessarily want to include everything, because administratively there is a cost to that. And so going through and identifying the appropriate materiality threshold for your organization, bouncing that off your external auditor, making sure they're aware of it. You will have to have substantive evidence to support that. And then, using that initial preliminary materiality to de-scope leases that may not be material, that may be administratively burdensome for the organization, so that you can truly get down to the leases that are generating the financial statement, a majority of the financial statement impact. And at that point, then you can kind of move forward after that. So in reality, that's one policy election that has to be done. The second one is the short-term lease exception.
Timothy, real quick though, before you pivot, have you seen? Because what we noticed when public companies were transitioning was to figure out that materiality threshold. They were piggybacking off their fixed asset policy. Is that what you're seeing GASB clients do?
No.
Are they piggybacking off that fixed asset threshold?
Yeah, I'm not seeing that, and that's partly because we don't recommend it, and secondarily because it will most likely give you too low a number. And again, the risks are different. So for fixed assets, they want you to capitalize it instead of expensing it in one period. It's not the same for leases, right? And so it really is driven by the size of the liability that you're putting on the books. So if you're putting $100 million on the books, a $2,000 lease is not material. It's never going to move that number materially. And so we've worked with some organizations that have been able to make the argument that all equipment leases are immaterial, because the size of that liability is so large. It would take a really large equipment lease in order to move that number anything materially. And so that's what we're seeing, and that's what we recommend, because you're going to first get to a higher number, and that is going to exclude more leases. And so it's going to make it a little bit more administratively easier to administer, and it's also going to focus your efforts where it really needs to be, which is where the dollars
are. I also think, kind of adding on to that, you definitely have to work with your external auditor with this and be able to prove out the dollar amount and why it should be excluded. I also look at grouping like leases together. So if you have like a bunch of copier leases, putting those together, looking at not only individually, but on aggregate on all the leases. So if you say you want to scope out this lease, what the dollar amount is and what they all are together as well. I think also, looking at your, discount rate that you're doing, because this can really have a huge impact as far as, the liability that you're putting on the balance sheet. So making sure, again, I think that this is a collaborative process that you should be speaking with your auditor as soon as possible on every stage and step on the way, so that you can make sure and get buy-in on the way that you're going and your policies that you're going to be implementing around leases.
A couple of considerations. So like you mentioned, you did a good job at the beginning talking about the differentiation between GASB and FASB on the determination of term. But the theoretical response is that you have to assess the total potential contract period of the contract in determining the term, not what you expect to use it for. So if you have a 6-month contract with 2 6-month extensions, that is 18 months of term, regardless of whether or not you only plan on using it for 6 months. It would still qualify for GASB 87. Then once you've done that analysis, then you can start looking at scoping, right? The materiality scoping. Embedded lease, we talked about that. GASB 87 does require you to separate your embedded leases when it's reasonable to do so. So if you have contracts that have both service and asset components in it, a good example that I use for everybody is like the coffee pot in the break room. You're not paying for that coffee pot with the contract. You're paying for the coffee supplies. But in the cost of the coffee, there is an implicit cost of the machine. And under GASB 87, that contract, theoretically, you're going to have to separate between coffee expense and the cost of the machine, if you can estimate that. Now, that's a classic example of an immaterial or a de minimis contract that would never go on the balance sheet. I'm not proposing that, but it's a good classic example of why it does take some rigor in getting through this analysis on the front end. Because at the end of the day, when your population is every potential contract could have a lease in it, you've got to have a really sound methodology for how you're going through it.
In GASB, though, you are required to separate those lease and non-lease components, right? It's a requirement, and you do not have. I mean, unless it's impossible for you to determine, what the standalone price is for the non-lease components. You're supposed to separate it and disclose it.
Exactly.
Someone wants to know, would heavy equipment, long-term rent to trade in or rent to own contracts fall under GASB 87?
I mean, I guess it depends on, are you going to be, is it a finance purchase? Are you going to be owning that asset at the end? So then that would be under your finance purchase arrangement. Or do you have control over that asset over the term of it, whether or not you own it in or not? And if you're controlling that asset, through this rental agreement, then yes, it would be scoped in. Remember that GASB 87 really focuses on this control aspect.
Yeah, I think you brought up a good point, GASB 88, which is the finance purchase, right? So if you're going out to a bank and getting a loan to buy an asset, that's not a lease, that's a finance purchase, right? And so if that's the case, then it follows a different GASB than if you were to enter into a traditional lease agreement.
Yes, my understanding is if there's a purchase option at the end, then it's scoped out of 87. You use finance, it becomes a financing transaction.
In determining whether a lease is short term, should we evaluate the maximum period for evaluation starting as of July 1st, 2021, our year of implementation? And so this is for existing leases as of the effective date. So I guess when you are transitioning a lease, when does that measurement of what is short term begin?
I believe there is an implementation question that does address this. And so if you take it as of the date of implementation, so that would be the earliest date that you're presenting in your financial statements, whether, July 1st, 2021, if you're doing single year, or it'd be July 1st, 2020, if it's comparative, it would be the date as of the start of your implementation. So if for some reason it could have been a 5-year lease, but at the start of implementation, you only have a year left, it's considered short term.
Great, thank you for that clarification.
You measured it on the appropriate contract term initially, which includes all of the potential option periods.
Got it.